Welcome to Mokama's Sunday service, and I'm Mo Stacks. Today we're going to be talking about options trading mistakes to avoid. Since April, I started a new trading strategy, and I've made over 150 options trades. And here are like some of the things that I have learned myself. So I made this wonderful presentation for you guys today. I'm trying to get through everything, so if anyone needs me to slow down, please let me know because, yeah, it's a lot of slides. All right, so, oops. Mistake number one, trading out of the money. Why in the money options have a higher probability to go in your favor, and they move more like the stock. The downside of buying in the money options is that they are more expensive, but they're more expensive for a reason. It's because they have a higher probability to win, right? So when you go to Thinkorswim, that's the platform that we use to trade, right? And you want to buy options, you're going to click on this trade tab right here. Make sure that all products is the tab that you're on inside of here, not Forex or futures or something like that. And then this is what you're going to see. You're going to see the options chain if you click this arrow down right here, right? And so when you see this options chain for a specific expiration date, you're going to have to click the arrow down to see all of the strikes. Make sure you have at least 40 strikes there. Sometimes when you open up your platform, there's only like 4 or 5 or 10 or something like that. I like to see at least 40 strikes. Sometimes I'll click this arrow down and see all of the strikes, but then you got to scroll through a lot of different options that may not be relevant, right? So that's one of the first things that I'm going to do. Number two, the layout. If you click in here in this layout section and go to customize, you can make sure you have all of the things that you see here on my chart: the bid, the ask, the volume, the last, the open interest, the delta, and the theta. That's how I have my chart set up. And the main thing when I'm saying buying in the money is buying options with deltas over 50 cents, right? So the delta is located here. And just to kind of show you how to customize your chart, like once you click customize, you can go make sure that you have all of these categories that I have here. You can search for them here and then add them and then click OK to make sure your chart looks like mine. So when I say in the money and deltas over 50 cent, I mean the options inside of the shaded region. That's considered in the money. And you'll see that all of the deltas, this category, and this is the call side, right? The left side is typically the call side, at least on Thinkorswim it is, right? And all of the deltas in the shaded region are above 50 cents, right? And same thing on the put side. Move this video. All of the deltas in the shaded region are negative 50 cents or below that, right? So that's what I mean by in the money. And the reason why these are considered in the money is because they have intrinsic value already. So right here, this green line is like, let me see if the next slide. This green line is, let's say, the 572 option for SPY. It's over, this green line is over that particular strike, right? But it's 572. So if we go over to the call side and we're looking at what's in the money, this 572 right here has a delta of 53. And so it has a higher probability of going up with the stock or the ETF, in this case, SPY. And so that's where you want to be buying. You don't want to be buying this cheap stuff down here, right? Anything underneath 572. And it has intrinsic value because the stock price currently is 572.98, at least as of close on Friday. So a call is an option to buy, or a call option is a contract to buy 100 shares of SPY at $572, right? You would definitely want to buy SPY at $572 if it's currently close to $573. That's why it has intrinsic value. It is already valuable. You're getting a dollar discount if you buy, but that's why it costs more in order to buy that option versus at a lower strike where you wouldn't want to buy 100 shares of SPY at $574 if you could get them for $573, right? So I have prior videos talking about call options, put options. If you don't understand that, go look at some of my prior videos. But that's why you want to be buying in the money options. And then what people mean at the money is kind of where that shaded region breaks. Like, so the 572 and the 573 strike, I would consider at the money, because depending on how the ETF moves up or down, that could easily fall out of the shaded region or go into the shaded region. So generally, like, try not to buy more than one strike out of this shaded region, and generally you're going to have a more high probability trade. So just talking about execution in general. So if I were to buy a SPY October 7th expiration date call at $2.36, which is here, with a delta of 53 cents, without taking in, theta calculations and gamma calculations and more difficult stuff, just to keep it simple. If SPY gains a dollar, right? So if SPY goes from, what was the price before? If it goes from 572.98 to 573.98, then the option increases to $2.89 or $289, right? Which would be $53 per contract. The reason why that's $289 is because an option is a contract for 100 shares. So when you see a price that says 289, you essentially just need to move the decimal point over 2. That's how much it's going to cost you to buy one of those option contracts. It's going to be $289. So if you bought an option contract at 200, or I'm sorry, if you bought it at $236, which is the current price, and it had a delta of 53 cents, if SPY gained $1, then you would have made $53 in profit, right? So that's what I mean by, like, it doesn't move one to one with the stock. It actually moved up $53 or 53 cents when the stock moved $1. And then the more in the money you go, like if you're looking at the strike above the 572, so the 570, I think this is 571, and the 570, right, that would move 60 cents or $60 for every dollar, or for every dollar of movement. And this would move 66 cents for every dollar of movement, right? So that's why, like, if you think a stock is going to reverse and go your direction and you're confident, like, you might want to be in the money a little bit more, because if you're in the money a little bit more, like, the value of your option is going to go up faster than options that are out of the money, out of the shaded region, right? And then this is kind of how it's going to look. If you click the ask on the option chain in Thinkorswim, this is the order that's going to come up. You know you're buying options when it comes up green. And then it'll have the instrument, which is SPY, it's a call, the expiration date, the strike price, the price here, and whether it's a limit order or a market order, right? And time enforce, all of those things as well, right? So this is how I get into trades, specifically, right? I usually use Active Trader on Thinkorswim. So what I'll do is I'll put up the instrument here, and then if you click this button right here, you can add a second window. And so you got to be on the charts tab. I'll put SPY here. And if I right click this, and I think I have a slide about this later, then it'll give me an option to copy the option chart, and then I'll put that in here in the second window. And then I'll click this button on the side of the chart, as you'll see it here as well on the side of every chart, usually default is Active Trader. I'll click that, and this is what comes up on Active Trader. So if I wanted to buy that particular strike at $2.36, what I would do is I would essentially hover my mouse right there, put the quantity in, and then I would click that to put in a limit order at $2.36. I'm just showing you how I execute it. You could also execute it this way, but I typically like to execute my trades on Active Trader because for me it's faster to get in on Thinkorswim, right? And also, if not in the car, but if I'm parked somewhere or I'm in the parking lot and or I don't have a computer in front of me, this is how it looks on the mobile, right? And so I took some screenshots on my phone. I use Thinkorswim on my phone. I actually think it's easier to get out of trades on Thinkorswim mobile versus the laptop or a desktop personally. It's faster for me to get out of a trade. So sometimes I'll enter a trade on my laptop and then use my phone to get out of one. Um, so this is how it's going to look. Same thing. It looks very similar. You have the delta here, your open interest, your ask. Like you could set it up just like you do with your laptop. And then once you click, let's say if you were to click the ask and then click the trade button, this is what's going to pop up, right? Whether it's a limit order or a market order, how long it's in force, the price you want to buy it at, the ask and the bid are here as well. The quantity you're going to buy, the cost of the trade, you click review, and then you click send, right? So mistake number 2, not paying attention to the liquidity and the spread of the options. Illiquid options and wide spreads make it harder to exit at your desired price, whether that's entering or exiting, actually. So when we're talking about what is open interest, it is the active contracts not closed on a particular option, and it shows you how liquid it is, right? How many people are actively like trading this thing or in a trade currently. The spread is the bid versus the ask price, right? So just to show you how I determine whether or not option is liquid is I'm going to look at the open interest. And this is why it's important to set this up and put this on your chart, right? So in terms of actual action items, buy options with an open interest greater than 1,000. Right. Some people would say 500 or more is fine, 700, 750. But for me, I generally am looking for something that's greater than 1,000. If it's like 950, I might enter still. But like, I want options that are really liquid because it'll be easier for me to get in and out. What I've also noticed is that the spread is typically smaller on liquid options. That's just what I've noticed, right? So if we're taking the same example with SPY, right, that same 572 strike at $2.36, right, the open interest is 3,153. So that's enough open interest for me to take that trade. And SPY is traded like a lot. So you'll see that SPY, even for a contract that expires really soon, is going to have a lot of open interest typically, right? Out of the money and in the money. So typically a stock like SPY or an ETF like SPY, QQQ, IWM, things that are heavily traded, Tesla, they're going to have huge open interest, and you're not going to really have a liquidity issues. When you're trading more obscure things, that's when you're really going to have a liquidity issue. And then just on the right here, this is what it looks like on a mobile phone. Same thing. You could be trading on your phone and still know what the open interest is, right? So just to kind of show you exactly what it looks like, this is how it's going to look like on a mobile look. This is how it's going to look like if you're on a laptop or a desktop, right? Looking at the spread. So this is what I mean by the spread. So the ask is where you could easily get filled. If you put in an order at $2.36, you're likely going to get filled, right? But you generally want to put your orders in closer to the bid. But you want to see a small spread between the bid and the ask. Here it's 2 cents. And we're using the same example with SPY because SPY typically has very small spreads, right? So generally you don't want to see this be, so if 10%, that's what I said, the spread should be less than 10% of the option price.
I was just helping out because they're down in the dining room right now.
Oh, okay.
Hold
Yeah,
on. Hold
should be
on.
here in a little.
Somebody, hold on, let me mute everybody. All right. So let me go back. Here we go. So when we're talking about the spread, you wanted to see it be less. In this case, 10% of $2.36 would be 23 cents approximately, 23, 24 cents. So you want to see a spread that is less than that, right? So this spread is 2 cents. So this is a type of trade that I would, or a type of option that I would buy because the spread is less than 10% of the option price. Here's an example where that is not the case, right? The spread here is ridiculous. The spread here is $4.60. That's a $400 difference. And so this is exactly the type of instrument, at least on this expiration date, that I would not trade. And XLI is actually on my list this week, but like I wouldn't be buying the near term option. I would have to go look at another expiration date because look at how crazy the spread is here. You would also notice that there's not much open interest here, right? So sometimes I might have a good idea of what I want to buy, but if there's not enough open interest and the spread is crazy like this is like a 90% spread, if not a 95% spread. So I would rather get in at 11 cents versus $4.75, but good luck in terms of trying to trade this thing. So this is where you might have a good idea, but you need to go find a different expiration date. Or if all of the expiration dates have really wide spreads, I just won't trade it because while the stock itself might be doing what you want it to do, the option is wild. And if the option is wild, that's not a good boat to be in, right? So mistake number 3, using market orders. Why? Market orders fill at less favorable prices, increasing costs and losses, right? So if you use a market order to enter, it's going to increase the price of your option if you're buying calls and puts. And if you use a market order to a stop market order to get out, like your loss could be filled, or your order could be filled at the bid. And if you have like XLI, what we just looked at, and you get filled here, right? That's a huge difference. If the option is priced, let's say if they price it in the middle at like $2.50 or $2.25, and you have a stop loss in there, and the bid is 11 cents. If you do a market order to get out, they're going to fill you at 11 cents. So you could potentially lose a couple $100 getting out. So, like, it's really important, especially if you end up in an option that has a really wide spread, that you are using limit orders to get in and to get out. If I used a market order to get in this trade, they would fill me at $4.75, when I would prefer to use a limit order to get me in at 11 cents, or at least somewhere in the middle of 11 cents and $4.75. Same thing getting out of a trade like this. If I were to set a stop market loss, a stop order for, which is generally a market order, and it triggers at $2, it's still going to get me out at 11 cents because that's where the bid is. That's where people are currently bidding for those options. So, like, you want to go in like a sniper, not with like a shotgun. So limit orders are a sniper rifle, market orders are a shotgun. The only the only the only time that I would suggest using market orders are if you have a really tight spread, right? So If you're in this 572 option right here in SPY and the price is 2 cents, a $2 difference, it's not going to make much difference if you get in at $2.34 or $2.36. It's not, a dollar or two difference isn't going to make a big difference. Where it does make a difference is if it's a $4 spread, right? So, like, you need to be wary of this, like when you're actually trading and what you're trading. So yeah, I'm going to be less worried about that if I'm trading SPY. If I'm trading something like XLI or something that's not traded as heavily as SPY and that people don't know so much about, then you really got to watch like where you're placing your orders, because you could get into a trade and already be down because you bought directly at the ask price instead of nearer to the bid. Right? So, mistake number 4, not scaling in and out of positions. Why? Because it is better risk management and gives you some price flexibility. So, this is kind of what my chart looks like when I'm getting into a trade. Like, so this is XLU. Actually, I'm currently in an XLU trade, the last leg of it. I think I have one option contract left out of like 12 that I bought, right? So, XLU, let's say, typically if I'm going to get in, this gray area and this yellow area represent daily price movement ranges of a tool that I use from Simpler Trading. And so if XLU, which is on my list this week, even though I'm currently in a trade, if it pulls back, and on a daily chart, even though this is an hourly chart, I like to enter on an hourly chart, even though I'm looking at a daily chart to trigger. Um, I'm going to have 3 separate levels potentially where I buy. And even though this is the same trade, I'm going to treat them as 3 separate trades. So let's say I have a particular budget for my account, and I'm going to allot a certain amount for a particular trade. And let's say that amount is, let's say it's $2,000, right? A nice round number. So 25% of $2,000 is going to be $500. So I might allot $500 here at the aggressive level. I might allot $500 here if it pulls back to the moderate level. And then I might allot $1,000 here if it pulls back to the conservative level, right? And so they're each going to have their own stop. I usually use 20 to 25% stops on options. So I might buy, let's say I might buy 4 calls here, 4 calls here, and 8 calls here. But the calls here are going to be more expensive. The calls here are going to be a little less expensive than this. And the calls here are going to be even less expensive than both of these legs, right? As it comes down. So I'm actually buying more here, but they're less expensive. So they may not cost much more than the options when I bought them here, right? And so this is actually like a way of like risk mitigation, because you have no idea exactly where this thing is going to bounce, right? You have a thesis that it's going to bounce, but like trying to call an exact price is really hard. So instead of trying to call it exactly, I'm just going to have legs everywhere. So this one, if it comes all the way down here, might get stopped out, but I might still be in this leg or this leg. Or I might decide to only take this leg and then only take the conservative leg, right? But it just gives me an opportunity to like get into a particular stock if I think it's going to bounce and never come all the way down here without taking on a huge amount of risk, right? So, and then if I'm going to size up, I'm going to size up at better prices. Right. And then what is this slide for? Oh, pulling up an option chart. Here was my slide, right? So if you wanted to pull up an option chart and trade on Active Trader like I showed you earlier, you're going to right click the ask, and you can actually do this with the bid too. And then you're going to click copy, and you see that .spy241 where that starts. That's like the identifier for the actual chart for the option itself rather than the stock. And then you're going to copy that, and then you're going to paste that into your second window, and then that's going to pull up the option chart, right? And where else? Oh, and this is what I wanted to show you. So then you can also scale in this way. So how I told you, like maybe at the aggressive level, I'm going to buy 4, right? And then at a less, at the conservative level, let's say that's when the option price is $2, then I'm going to buy 8. That's where I'm going to size up. And so you can do that on active trader as well, right? So sometimes, like, especially when I get in at the aggressive level, I'll just go sit my conservative letter, figure out where my conservative level is, and then go sit that down right there. It's usually about, I usually calculate at like 20% below where I bought the aggressive level, right? Is where the conservative level is going to be. And then I'll just go sit an order of double down there. And if it triggers, this is the one that usually is going to make me the most money because the stock, at least how I trade, is going to be more exhausted by the time that it gets down here and more likely to go up. I just hope that my more aggressive position doesn't stop me out, and that I can keep both of these positions rather than like losing one and then keeping the more conservative position. So mistake number 4, uh, not scaling in and out of positions, right? So sell partial positions when profitable, right? This is still, oh, we're already on mistake 4. So this is the scaling out part. Sell partial positions when you're profitable, right? And the class that I'm taking, the mastery that I'm taking, her saying is take profits when you can, not when you have to, right? So this is the reason why you want to buy multiple contracts if you can. If you have a big enough account, or you're buying options that are less expensive but are in the money, if they're priced at $1.50, those are going to be more scalable where you can maybe allot $500 and then get into at least 2 contracts, right? So for smaller accounts, you might only be able to buy 2 contracts, but I suggest buying more than one because you want to be able to scale out of things, right? Number 2, you should not be entering any trade before you know where your stop loss is and where you want to get out and where your trigger is, right? So those are your 3 things. Where's your trigger? What's your thesis? Where's the level you think it's going to bounce or go down? Number 2, if it does go your way, where do you want to get out? Number 3, if things go bad, where do you want to get out? If you don't have those 3 things ready, you are not ready to enter a trade. You don't have a setup. You are just gambling, right? So those are 3 things that need to be predetermined before you enter an options trade, right? So take some money off the table. So here's the same chart of XLU, right? Here's my aggressive level, my moderate level, my conservative level. My target number 1 is going to be right here, right before it gets to this overextended range here in the yellow, right? So that is my predetermined target. So I'm going to have a limit order sitting right there to sell half of my position if we hit this target and XLU comes up to 81.48. And this is a hypothetical trade that I'm taking you through, right? I would take, if I bought, let's say 12 contracts, I'm taking 6 off right here. If I bought 4 contracts, I'm selling 2 right here. If I bought 2 contracts, I'm selling 1 right here, right? Take money off the table, take profit, and then once I take half of those contracts off, then I'm going to have my stop loss set at break even. Wherever I got in the trade is where my stop loss is going to be. Then I'm no longer risking my 20-25%. I'm only going to be ready to risk house money and get out the trade so that this is going to be a winner, a guaranteed winner. Right? So mistake number 5, not position sizing. Right? No single trade should risk your entire account. So if you have a big enough account, only risk 1 to 3% of your trade or of your account on any trade idea. The goal is to survive and keep trading. Be a cockroach. right? If you have a smaller account, which is under 25K, you may be subject to the pattern day trading rule, right? So the way to get around this is number one, you could have a cash account only and only buy options and don't sell spreads, right? If you know me and you've been paying attention to me, I sell spreads and I buy options. It just depends on the setup, right? So if you have less than 25K in your trading account, then you can only make so many trades a week if you're trading with margin. So you either have to limit your trades to only making one or two trades a week for to not be flagged for the pattern day trading rule, where you won't be able to get in and out of a trade if you trade more than I think 4 or 5 times. Don't quote me on that. It's something like that. Or keep more than 25K in your account is another way to not be a pattern day trader. And then number three, if you only buy options, and you're not selling spreads and you don't need a margin account for that, then that's another way you can get around the pattern day trading rule, right? So it's hard if you have a smaller account to not risk 1 to 3% of your account because you have a small account and some options are expensive, but you essentially got to limit yourself to options that only cost $1 to $2. You can't be buying options that cost $6, $8, right? And this is what I mean by expensive options. If you were to try to get into Meta on this expiration date of October 11th, right? Each option costs nine bucks. That's $990 to get into Meta, right? At the money, right? And you don't want to go out of the money. Out of the money are cheaper, but look at the delta. It's 11 cents. So it's going to take $10 of movement for you to gain $1 on this contract, pretty much, maybe a little less because it's going to keep climbing the ladder. Like $6 to $8 a movement, right? So, or not even $6 to $8, 6 to 8 strikes is what I mean, right? So, like, you need to stay away from expensive options if you have a small account. You can't scale into these. If you can only buy one, you're not going to be able to scale in and scale out. So, like, don't buy really expensive options. Or you're going to be risking too much of your account. Try to buy things like we were seeing the SPY options for $2 and like 36 cents, right? That's like a fourth of the price of a Meta option. So, yeah, stay away from expensive options if you have a small account. Bonus tips: cut losers fast, let your winners run. Options, I would keep a stop loss of around 20 to 25% on average. Maybe you might do 15% if something's really exhausted, but you need to have a little bit more wiggle on your options versus trading shares. I used to trade shares too. Shares move 1 to 1, so like you can, have a shorter stop, but options are going to wiggle a little bit more. And if you have a 5%, 10% stop loss on an option, you're going to get stopped out almost every time unless it goes in your direction. That's my experience, right? And my goal is to always play with house money after taking profits. That is my ultimate goal. Get to a point where I hit a target one and then move my stop to break even. And then I'm essentially just playing with house money. I have a free lottery ticket. That's my goal. Expiration dates also matters. If you're buying options, it's better to buy options with longer expiration dates because time decay is going to be less the further out you are. If you're buying options that expire this week or today, if those 0 DTE options, then time decay is going to really affect your option, where you're going to need to get in and out of that trade in 30 minutes and an hour if you're trading 0 DTE options, specifically if you're buying options. If you're selling spreads, which means you're on the other side of time decay, you're making money from time decay. If you're selling options, then the opposite is true. I would rather sell a spread with a shorter expiration date because I want that time decay to happen really fast, because that means I get to keep the premium. So if I'm selling spreads, I want a shorter expiration date. If I'm buying options, I'd rather buy further out if possible, if there's liquidity there, right? And let me go back. That's probably the biggest thing that's going to affect this one way or another. While I might want to sell a spread with a shorter expiration date, what might prevent me from doing that is there's no liquidity there. And while I might want to buy an option with the longer expiration date, what might prevent me from doing that is there's no liquidity there. So it's like if all of these things are true, these are kind of like my checklist, right? And then avoid over trading. Only trade the strong setups with good risk reward. Doing nothing is better than losing money. So sometimes you're sitting there for an hour or two and then you're just gunning it. You're slinging trades, even though there aren't any prime setups for you based upon your setups, your trading system. And you should have a trading system like where, hey, if this happens, then I'm going to do this, and it has this sort of risk reward and this sort of ratio, a win loss ratio. If I have this sort of setup, that's what I mean by a trading system. But if your trading system don't trigger, stop being a cowboy. If and this is what I mean, like with XLU again. If XLU comes down to this purple line, it's not triggering for me. It's me having FOMO, right? My system says don't buy it until it comes down to this white zone. So if I bought at this purple, I am not following my system. And the reason why I want to buy it at this white zone is because the risk reward is better here than it is at this purple line or than it is here in the middle, right? If I get it down here, the risk reward is even better to swing it all the way back up to where this yellow zone is. But if I'm here or I'm here, I'm in no man's land. So that is not my system, right? That is me. That is FOMO, me thinking, hey, I'm missing a trade. No, my trade never triggered. If it never came down to this white zone, there was never a trade to be had in the first place. The white zone is where the risk reward is better. All right. Any questions? I know I muted y'all, so let me see. Can I unmute? Um, any
Rom,
question?
everything makes sense.
All right. All
Good
right.
overview.
So my weekly stock picks for this week. This is a good time for me to do my disclaimer. This is for informational purposes only. This is not investment advice. Trading and investing are risky. I am not a financial professional. So direct your questions to your financial professionals and do your own research and trade at your own peril. But with that said, here are the things that I'm looking at this week. And once again, when I tell you these are my picks, this is not go out Monday and go buy a bunch of calls on these stocks as soon as the market opens. No, my strategy is buy these things when they get exhausted. So I buy stocks that are, or I buy options or calls, or sell or buy puts on things that are really strong or really weak. But I want to buy them at points of exhaustion. So if something is really strong, what I'm waiting for is a big down day on something that is really strong. And then I'm going to buy it on that down day, likely a call to the upside. And so what's hot this week? I don't know why I have all these extra slides today. XLY, we talked about this last week. I'm in a couple of XLY trades right now. I am in an HD trade, Home Depot, and a Tesla trade right now. And XLY is consumer discretionary. Oh, I know what was supposed to be there. My Koifin chart is supposed to be there. So let me do this. Can you guys see my screen?
Yes, sir.
All right, so this is Koifin. It's a free app online. You can upgrade, but I love their free product as it is. Right, so what I do is I go to the market dashboards, go to the U.S. sectors. Right, that's what's supposed to be on that slide. It's missing. And then I'm looking at what's been strong over the last month for a swing. Right, so here's what's been strong: XME, metals and mining. SMH has been coming up, right? But you'll see that these two are on my radar, but not on my list because they are more recent trends. The stronger trends that have been trending over a longer period of time is XLY, XLU. I'm in an XLU trade right now. I'm in two stocks inside of XLY. XLK is a more recent trend that is on my radar. XLC is a stronger trend, longer term, so that's on my list too. Gold, this is GDX. I don't like trading GDX as much as I like trading the ETF version of the futures, which is GLD. And then you see oil, services, industrials is on my list. That's been a longer trend. Oil is newer, and I would say that's probably because of the Israel Lebanon stuff going on right now. Energy, same thing, right? And then the laggards right now is consumer staples, the regional banks, and healthcare, right? But you see, everything is mostly over that 0% line, which is telling me that the market right now is bullish, right? If most of the sectors are positive, then we have a bullish market. We only have three negative sectors right now. So I'm not trading puts or buying puts at all right now. I'm buying calls or I'm selling put spreads. Just because what this overall picture is telling me is that, hey, right, we're bullish. So going back, XLY has had a stronger trend. So these are the names kind of in order that I would trade. Would be Home Depot in that trade, Lowe's, McDonald's, and Tesla. Amazon is off my list because it fell out of trend. It's mostly flat, right? So just to show you XLY, once again, if you know my screen and my setup, this green line is a 21 exponential moving average. And we have a 34, a 50, and a 200. The shorter periods are above the longer periods, which tells me that this sector is mostly bullish, right? It's trending. So I want to find a pullback on a trend. Home Depot is trending as well, right? This is why I bought it on this candle way down here is where I bought Home Depot, right? I already scaled out of this trade already, right? Because something bullish had a severe pullback. I grabbed it and then it bounced right back up, right? To the end of the day, right? So this is a key, this is like a key setup for me. It triggered my alert triggered on my other chart. It entered the white zone and even got down a little further. So that's when I bought it. And look, even you see my ATR, which is this green line, it came down below the ATR too. So it's overextended. When it was overextended, I bought it down there at that level and it immediately popped up. By the end of the day, I'd already scaled out a half of my position at that trade. I am now playing with house money on this HD trade, right? So this is like a prime setup for me. Lowe's did almost something similar, but it didn't look as good as HD. And I feel like I looked and the options were a little less liquid. Did the same thing though, right? In the same sector. Tesla, I didn't buy this Friday. I bought Tesla on Thursday, right? And in fact, I alerted this out to all of you guys when I did it. Same thing. Something that is in trend. I liked HD more than Tesla because Tesla isn't as strong as you see. These lines aren't curving up as much as they were on HD. So HD has a stronger trend. So I would say this is a stronger trade for me. But Tesla did what it was supposed to do, where I was able to scale out of this as well. And I took this one with the spread because I didn't believe in it as much as the HD trade. And Tesla is more liquid, so it was easier for me to trade this one with the spread versus with standard call options, right? So same thing with Tesla. I scaled out a half because it got up here, and I'm playing with house money now on the spreads, right? And more importantly, they are in a boat that is also trending up and has been strong, which is XLY, right? So these are components in a boat that is, or in a tide that is moving a certain direction. So I was less hesitant to trade these things because the sector that they're in is also bullish. Another thing, XLU, NEE. As I said, I'm already in XLU. And have been, I think, since this day or this day. I've been in that XLU trade for a while. I think it was this day I got in. So, same thing. XLU has been bullish. This has been the most bullish trend that I've shown you. It's been rather consistent. So, I'm just buying it on a pullback day. On a day that it comes down, this would have been a good day to enter too, right? When something bullish has a correction, comes back down, right? It looks exhausted, then it's more probable that it's going to continue its trend if it's been trending. So taking XLU on this pullback, or this pullback would have been really good for you, you know? So XLU looks really nice as well. And NEE, Nextera Energy, same thing, looks very similar to XLU. It's one of the biggest components inside of XLU. So actually looking, I probably should have bought on Friday. This is one I'll be looking at next week, right? This looks like, because it gapped down, this looks like a significant pullback. I probably should have purchased something on Friday. Another hot sector, XLC. You got Meta. And then instead of Google and Netflix outside of Meta, the phone companies look really bullish right now. And I don't trade these things. And so for me too, this is another thing. If the news is not talking about it, I love it, right? If I'm looking at a place that nobody else is looking at, like I want to be in that quiet trade. I don't want CNBC to be saying Tesla's going up or Nvidia's going up. I want to be in the quiet trade where nobody else is looking and I want to be there first, right? That's my goal. So XLC has been pretty bullish. This is the sector. This is the communication sector. Most heavily weighted, it's Meta, Google, Netflix. But I only really like Meta, and then the other, the Verizons, the phone companies inside it, right? So you see, same thing, shorter period averages are on top of the longer period averages, which means it's pretty bullish, pretty steady trend, higher highs, higher lows, right? So we have bullish activity. Meta looks good, right? Strongest trend. It's been coming. So if Meta pulls back, love Meta. The only thing with Meta is what I showed you earlier is that the options are really expensive. So I would probably trade Meta with spreads versus uh, calls, but you need to have a big enough account to not have like a pattern day trader issue and have enough margin to trade the spreads on Meta, right? But look at Verizon. I had a trigger out. It didn't quite reach the 34, which is where I was my trigger buy was on Friday. But I like Verizon. Look at that. Shorter period averages on top of the longer period moving averages inside of a sector that is also bullish. Look at T-Mobile. Look at all of these green candles. That's like 10 straight green days, right? Love T-Mobile. Love AT&T right now, right? I love the telecommunication stocks right now. I'm not saying buy this long term or invest in this. I'm saying this is what I'm going to be looking to swing trade, which is way different. I wouldn't hold any of these things in my IRA or my retirement accounts, but I would swing these things for a couple of weeks, especially if they look like this, right? Look at that bullish activity on this stock. So that's kind of like my sneaky area for this week is if we get a pullback in any of those names. I don't think many people are looking there, so that's kind of where I want to be. Right. Same thing, XLI, but inside of XLI, Caterpillar and Raytheon. Not Uber or GE. I had GE on my list last week. I had a trade where I think I scaled out a half and then broke even a little bit, right, and got out of that trade. So I had a little winner on GE, but it's less trending than Caterpillar and RTX right now and XLI itself. So I'd rather be in XLI itself as the ETF, right? Looks bullish. Caterpillar looks really bullish. Looks like it's breaking out. And RTX looks steady as she goes, especially with the warpath going on right now, right? Raytheon looks really good. So commodities, here are two sectors or two specific commodities that I've been looking at. I'm currently in a natural gas trade right now. Gold, I've been looking at gold for the last month or so because it's continuing to break highs and have new all-time highs. Higher high, higher high, higher high, higher high, higher high, higher low, higher low, higher low, higher lows. And look, the shorter period moving averages on top of the longer period moving averages. So still bullish. So until it breaks that trend, I might be a little bit more wary with it because it's a little overextended. But if I could trade it with spreads, GLD, I'll trade GC, the futures through GLD, which is gonna look just like it. Um, Try to trade it with the spread, but I'll still take a call on it because I'm just following the data, right? Following my system. It's a trending stock. If it pulls back significantly, I'll take a flyer on it, right? Natural gas, same thing. It's more newly trending. So this one I'm probably going to give a shorter leash to. But so far, so good. It held on Friday. I got in, like, I'm down like $50 on it. So I got in close to this bottom candle, hoping that it doesn't break this low right there. And it held. So that's why I got into natural gas through UNG, which is this ETF alternative for the futures. But this is more of a newly trending stock. But you see lower period or shorter period moving averages on top, and they are breaking through the longer period average too, showing some bullish momentum. It was trending and then pulls back. So that's usually when I want to hop in, right? So that was what I alerted to you guys on Friday as well. I hopped into natural gas at the end of the day, right? That's a significant pullback on something that's been relatively strong. All right, and what's on my radar? What I showed you on CoinFin, XME, the heaviest weighted in XME is FCX, Freeport McMoran. So those are starting to trend. They're not strong as the trends that I just showed you. So like, but they next week that could change, you know. So I'm definitely looking there, as well as SMH, and to see if tech can start outperforming like some of the other sectors more consistently rather than going up and down and up and down. So I'm waiting to see if SMH can break some old highs and XLK can break some old highs and start to trend a little bit better, and then I'll start trading pullbacks on those as well. Right. Weekly news for next week. We got on October 9th, the minutes of the Fed meeting where they reduce rates are going to be released. That can move the market sometimes. We got CPI inflation data on October 10th. The inflation data has become a little less important than it has been recently because we know the Fed is starting to lower rates. And then you got GDP and unemployment, and that's important because I feel like if that data is bad, the Fed is going to lower rates faster or cut quicker, um, in terms of like maybe a bigger cuts. So I think that could potentially affect the market as well, right? And then next week, earnings. We got Pepsi earnings. That's going to affect XLP and everything in the consumer staples sector potentially. And then you got the banks that are going to kick off this next earnings season for Q4, right? You got JP Morgan and Wells Fargo, and I think Progressive reports, and some of the insurance companies, which is the XLF ETF or the financial sector. And that'll show us too, like, hey, if the banks do really well, we might start blasting off into the end of the year, right? And it'll give us some more fuel to be bullish for the end of the year. Especially JP Morgan. JP Morgan is the behemoth in the big bank sector. So that's one to look at. And if you had one in your long-term portfolio, JP Morgan is the one to have in your long-term account versus like a Wells Fargo, a Bank of America, or a Citi, right? All right, folks, that is my presentation on the options trading mistakes to avoid, as well as my weekly picks for this week. Before I move on to kind of give you one trading example before we leave, anybody have any questions?
Going this way.
All right. Let me stop sharing that. Oh, I got done right at 9. That's crazy. continue. Can you see my Thinkorswim?
Yes, sir.
All right, so I'm just wanting to walk you through that Tesla trade that I made last week on Thursday. So what happened to Tesla? It was in a sector that we talked about last Sunday in XOY, right? In a strong sector, and it my alert was set right here. So just to show you how I create alerts, right click, click create alert, at or below, right? So I woke up that morning, I charted. I usually go set a price level right there, and then I'll set an alert. And so, and then I just leave it. So at 6:30, from 7:30, 6:30 to 7:30 before I take my daughter to school, this is generally what I'm doing. On all of the names that I just gave you guys, I'm going to go look at where the daily price movement range or where the ATR is for that day, and then I'm going to set an alert. The ATR was down here, the daily price movement range was a little bit above it, the bottom of it was around where the ATR is, right? So that's what I'm looking at. So um, I'm like, hey, if this gets down here, I know I'm going to want to buy at the aggressive level. The aggressive level is going to be here. The moderate level is going to be somewhere in here. The conservative level is here. Sometimes I might mark off the conservative level too, so that I know if I'm trading on my phone, it's going to pop up on these price levels are going to pop up on my phone, and I know that's my range where I want to be buying things, right? So then I went, okay, it triggered. I got an alert on my phone. It said, hey, Tesla's below 238.64, right? And I actually want to see if it's there. Triggered. Where's my Tesla alert? Oh, it only has the active and the ones I've canceled. So I wish I could show it to you. So then what I'm going to do is I'm going to go in the option chart. So this is what the option chart is going to look like when it's not expanded, right? When you go to it. Here's the option chain, right? So if I looked at October 11th, I know typically I want to be a little further out, and I know OpX is the 18th, right? So this was the option chain on October 11th. It probably didn't look like it at that time. Things were probably less expensive. Um, so what I wanted to do is, so I'm thinking, hey, should I buy a call or should I sell a spread? And at that time, I saw that the contracts that I was trying to trade for a spread were liquid, right? So I sold this contract here, and I forgot what I sold it for because the prices are different. And I saw the open interest was 9,000. So I was like, great. The one that I bought, and you'll see it's green here, red for sell and green for buy. The one that I bought, I usually do two strikes away. Was a decent enough price, over $1. I think it was like $2 of the spread, and the open interest was 3,700. So I was like, okay, check, check. I can sell a spread because the two contracts the one I want to sell and the one that I want to buy have sufficient liquidity for me to be able to get out of both of these relatively quickly if I sold a spread. So I sold the spread. And because Tesla isn't trending as much as like Home Depot or Lowe's, I want it to be more conservative, and selling a spread is a more conservative trade for me because I'm taking advantage of premium. So then what I did was, I think, how many contracts did I take of this? I think I took four at the aggressive level. I sold four contracts of this at the aggressive level for, let me see. Yeah, because I have two I've scaled out now. I have two left. I sold four for $2.50. 12.90 minus 10.40 is $2.50. So I sold four, so I collected about $1,000 in premium for selling these four contracts. Then I sold two when I was up 25%. And then I have two runners left that where if this goes back to $2.50, then I'll get out of my trade, right? I'll have a break even on this, right? So, and you'll see I also set an alert for myself, right? Where is the vertical alert? And I got to show you how to do an alert. It's easier to do on my phone. But I essentially set an alert where if this goes below, this spread goes below, the value of it goes below or above $2.50 because spreads are actually backwards. Your goal is to sell a spread for $2.50. Let's say that's my example. I want to buy it back for $2 and then keep the 50-cent spread. So it would be like $50 per contract. Or my goal would be to sell a spread for $2.50 and then the value depletes all the way down to zero and then I get to keep $2.50 or $250 per contract, right? So with spreads, I want to get in higher and then buy it back, sell it for higher and then buy it back for lower. If I'm buying calls, I want to buy calls for lower and then sell it for higher, right? And so that's pretty much how I tackled that trade. Is once it triggered, I came in and sold this put spread. Selling a put spread is a bullish trade, and then it went up on me, right? And then I think I probably had a target around here or 25%. So my target was somewhere around here, and I got out a half. And then now, like I said, I just have a runner. I have two runners where my stop loss is probably somewhere around where I got in, probably here, especially if I sell the spread, it might even be lower. And so I'll just let it keep running. And if Tesla wants to take off on Monday, so be it. If it wants to come down here and stop me out, then it stops me out, right? Any question on kind of like why I took that trade and how I executed it,
No, sir.
right? And then you'll see how these things move. The two contracts that the one that I sold and the one that I purchased are out of the money now. But at the time that I bought them, the 240 was in the money and the 235 was out of the money. But they're going to move, right? So right now, 252.5 is in the money because it is higher than the current price. But if we go back here, when it triggered, this was at 238. So the 240 would have been right here at the time that I took this trade. And then as it's gone up, the value of all of these options have decreased, which means I made money, right? On both of these. I kept premium. And this is really what you want to see happen on a spread. And conversely, the same thing. If I would have bought that 240, right, when it was here, now it would be here. So that would have went from like $12.75 to about $8.30 or 18 or no, from $12.75 to $18.30. So you would have made about $5 and some change or $500 and some change on every option, right? So, and this is also what I want to show you. Buying calls has more upside, but it also has more risk, right? So if I would have bought this call for $1,200 and $1,275, that is more risk. That is my loss potential, but it goes up like potentially exponentially where you could have made $500 on every contract. Now here, when I sold this spread, I only risked $1,000, right? Because they only cost 250, 250 bucks. So I'm risking a little over $1,000. But and it's a safer trade, but my reward is limited to $1,000 on this trade, versus my reward here is unlimited upside until the expiration date if I buy calls. So this is also how I'm starting to tackle things too. If I'm at the more aggressive level on Tesla, I might sell spreads, right? I might sell a put spread. But if it comes all the way down here to the conservative level, where my risk reward is better and where the likelihood that it's going to bounce is going to be better, I might buy calls here. So I might sell a spread here and buy calls here because I'm more confident it's going to bounce if it gets all the way down here, that it's going to be more exhausted and come up to the upside. So that's another thing that I'm kind of throwing in too. You can't do that with everything though. So like if we go look at like XLI, um, there may not be liquidity enough for you to do that, right? So if I were trying to sell an XLI spread, I couldn't do that because number one, the spreads are really large or really wide here, and there's no liquidity on this one. So on XLI, like number one, if the spreads are this wide, I won't be trading XLI next week at all, right? Or I'll go look for a different option price, right? Look at it. Yeah, I'm not trading if, and I'll look on Monday. But if XLI is going to continue to be this wide, I will not be trading it next week. I try to trade something as a proxy like Caterpillar. Has expensive options, but they're more liquid. I would try. I would be more likely or more inclined to trade a Caterpillar. Uh, Even Caterpillar doesn't have any liquidity for a spread, so I might not be able to trade Caterpillar too. RTX looks more like it. I would probably go higher in the money. RTX calls are liquid. So if XLI is triggering, I'd probably more likely trade RTX because we got some liquidity on October 18th. They're under $5, so they're priced well, and the spread is less than 40 cents, which is 10% of this cost. So I would probably trade RTX over Caterpillar and XLI, right? And I'm just kind of, and then I couldn't trade spreads because there's no liquidity on the put side on the spreads. So really, if RTX triggers next week, I'm trading calls on RTX at this at this level or this level where there's actual liquidity, right? So you guys see like how I'm kind of distilling my watch list and determining what to trade even from the option side versus what not to trade.
Yes, sir.
Right? And does that make sense? We were talking about this last night.
Yes.
Right. Just scanning. Like, hey, if RTX, and then so I'll go show you if I go pull up RTX on my chart. Let's say this was Friday. The level that I would have wanted to buy RTX aggressively would have been right here. It nicked down, barely touched it. um, and the reason why I want to buy it, because this is my daily chart over here. These are some indicators that I purchased from Simpler Trading in my class. Like the momentum is bullish, the trend is bullish. And you can see that too if you go pop out to a normal view, right? And I showed this to you earlier. And I just want it when it pulls back sufficiently. And so that would have been the level right there. So if it would have triggered at around 123.18, I'm going to go look at the chart and go look at an option that's going to be in the money when it gets there. So at 123, the 124s are going to be out of the money. So these and up are going to be in the money. So I'm looking for anything above here that has good liquidity, and these 122s have liquidity. So this is what I would do. I would right click, go to copy. I'd go into my swing trading chart that I've customized for myself. I will put in RTX here, right? Then I would go put in the option there, and this is how I would get in. It would be just like this. And then what I would try to do is, and this is something to show you too. So let's say my budget is usually $1,400 for my aggressive level. I've just done my calculation already. So if the option price is currently around, I know it's going to be lower than 370, probably around like 325. Then I'm going to divide that by 325 to figure out how many. Oh, hold up. What's that? Let's say what did I say? 1,400 divided by 325. So I can buy like 4 of these contracts, right? That's my budget for this, right? If I'm position sizing. Then I'm going to come down and figure out where this limit order is going to be based upon my levels. So if I want to sit that down, and I wouldn't suggest doing this until it gets closer to your alert. So I might put my alert maybe a little bit higher than this level. But I'm going to sit that down maybe to like just keep sliding that down right there. So around $2.80 is going to be my entry price for this option, right? And then if I want to buy 8 or double up at the conservative level, that's probably going to be closer to $2, right? Right there, maybe even a little higher, 205, maybe 210, 215. And this is what I'm doing. This is what I do. I just go approximate, And then okay, bam, I might even put it a little bit further because the option price time decay is going to deplete the value of the option price a little bit. So I'm just going to kind of go approximate my levels. And then, so, oh, that's where the 8, where the 4 at? The 4 is here. So I might move that a little bit down, right? And then I'll just have orders sitting there. So then I don't have to be fumbling with the keys, trying to punch things in. If I come in and do this just like this, I already have orders sitting at the levels where right just below my alerts or where I want to buy, right? And this is how I'm going to enter a trade. And recently, I've only been taking the aggressive level and the conservative level, or the moderate level and the conservative level. So I might have like 2/3 of a position on. Um, but yeah, right? Did you guys kind of see how I did that? Like from this is pulling up the option chart. So I have the option chart here. And then even here, the orders are on the option chart and they're actually on the stock chart. So, because I'm trading these options based upon where the stock price is going to be.
Yeah.
And then you can just sit your orders out there so that you don't have to fumble with punching in an order right away. And then if like for instance, if you think, hey, this might because of option pricing is volatile, this might be up a little bit, you could just sit that order down a little bit. And then when your alert triggers, if you set an alert down here, which is what I'll do, and that triggers, then you can go look at it and you can go, hey, this thing is bouncing. Let me move my order up a little bit to like 5 cents. I'm okay with losing $5, and then it's more dynamic. But me, I just kind of like wait and then like, hey, if RTX comes way down here, I'll look at what the price looks like at that time, set my orders, and then just every now and then I'll just get an alert on my phone that says your order's been filled. Your order's been filled, and it's been filled at prices that I want them filled at. I've already done the research, so that way I'm not. If it just gives me a quick wick down like it did that day, I could potentially get into the trade and not miss it. Versus like if you're taking 5 minutes to get into a trade, it might be gone by the time like you're ready to get into that trade. So
Hey, what
execute.
are the, oh, sorry.
Go ahead.
I'm wondering, what are the blue columns in the middle chart?
Which one?
That,
Here. Here.
the middle chart, that blue column, yeah.
Volume.
That's what I thought.
Just on the chart. I could take it off. And I don't really care so much about the option volume, to be honest. I'm mostly worried about where this stock is. Is it exhausted? Like at a level where I want to purchase this and then swing it back up to the top. That's what I'm looking for. So, like, it's not going to be exhausted until it gets down here. And that's when I want to take it. And this is just this white portion on the daily chart. Like if I switch to a daily chart, right? That white area is in the daily chart too. At least on my, it's an indicator I have. But I know it's trending, right? It's in a bullish trend. The moving averages are heading up and on top of each other. So I want to wait for this to pull back. And right now, if you really like trade patterns, it's bull flagging right now. And bull flagging is a bullish pattern. But a lot of people take the bull flag entry. Dang it. A lot of people take the bull flag entry here. Like if the can like so from a flag standpoint, the neck would be like right here. And then if you draw right, it looks like a flag, right? Kinda. If you look at this candle and here it looks like a flag. This if you're a technician and trade off chart patterns, this look like a bull flag. A lot of people take the bull flag when it breaks this line right here, this neck line, this top line, but I like grabbing things at exhaustion. I would rather get it at the bottom of this line here before it comes up and sell here rather than waiting for it to break out. So like this
Quick
is literally
question.
go ahead.
So when you're saying they're taking the bull flag, are they taking it to ride it up or down?
Well, bull flags are bullish signals. So most people who are momentum traders, like, so our Monday candle is going to be to the right of this candle right here on Friday, right? Wherever, I don't know where it's going to open Monday, right? Most people don't enter the trade until it breaks this red line that we have here. And I'm going to extend this red line to the right too. And you'll see it looks like a flag, right? This long candle is the pole. And then these lines right here are the flag, right? That's what people call a bull flag
Yeah, I see it.
from a chart pattern standpoint. Most people take a bull flag when it breaks this top red line here. However, I would rather grab the bull flag at the bottom because that's better risk reward. So if this comes down here in this gray zone, which it tapped on Friday, it would have been better for you to grab it here and then sell half your position at the red zone at the red line rather than waiting for the breakout because this is also going to serve as resistance too. But it's a better trade and you're going to get more of the meat of the move if you grab it down here between these two price levels rather than waiting until it gets all the way up here to take it. And this is the fundamental difference between a momentum trader versus an exhaustion trader. Exhaustion traders are going to grab it down here. Momentum traders are going to grab it up here. From a risk reward standpoint, exhaustion trading is way better from a risk reward standpoint. That's why I don't momentum trade anymore. That's my 2 cents. I'm not saying momentum trading doesn't work. It's just I feel that there's better risk reward and probability after something is exhausted from a supply and demand standpoint rather than waiting for something to be on fire to catch more fire. I'd rather catch it before it leaves the station and then sell half my position as it's catching fire and then leave 2 or 3 runners. And then if you want to cancel all this stuff on your chart, just click the X, right? Click the X. Click the X. Bam. Now they're gone. All right. So that's just kind of walking you through a trade that I took last week, walking you through a potential trade on RTX next week, hypothetically based upon Friday's price movement. But this section is going to be different on Monday because when you're calculating ATRs or daily price movement ranges, they are going to be different every day. So this might be lower, it might be higher, depending on the price movement range and the calculation throwing in Friday's price to Monday. So that's primarily how I trade. If I'm trading options and I'm just buying calls or buying puts, I'm going to trade it in a window that looks like this with active trader to get in really fast. If I'm selling spreads, I'm going to use the order entries down here to sell spreads because outside of the phone, and that's why I actually like trading with my phone sometimes, you can pull up a vertical chart on a phone. I haven't found a way to pull up the vertical chart on the laptop or desktop platform. I'm sure there's a way to do it, but I find it way easier to do it on a phone than it is on a laptop. So if I trade verticals, it's actually easier for me to enter on my phone than on a chart. So that's why I actually use my phone a lot to trade. and some traders will cringe, but I find it easier to get out of trades on my phone, and it's easier to get into spreads through my phone versus on a laptop or a computer. All right, I think that's it for today. We kind of went over, but it was kind of an extensive lesson today. I am going to, I updated the guide for this lesson, and I will make it available in the link. There'll be a link to this video once it's posted, where you'll have an opportunity to download the guide regarding options trading mistakes to avoid. Before we leave, any other issues, questions, anything y'all want to go over? Something that
Yeah,
wasn't
real
clear?
quick. Just so when looking between an option or a like a all option or a put spread, you're kind of looking at the price of the option because it's typically higher and the volatility of the stock itself.
Well, you mean in terms of whether I'm going to take a call or sell a put spread?
Correct.
The main thing that I'm going to use to determine, I would rather take a spread or sell a spread because it's a less risky trade. Time decay
Hmm.
is on my side. So as we get closer to October 18th, if I sell a spread, I'm going to make money when time goes by rather than lose money if I buy calls. Time decay is negative if you buy calls. If you sell options or you sell a spread, then time decay is on your side, right?
Yes.
So that's one of the main things. But if I'm looking at RTX, if I'm trying to sell something, I usually try to sell the put that's right in the money and then buy the one that is two out of the money, right? And so
Hmm.
if there's no liquidity there, it's under 1,000, I'm not going to take that spread
Hmm.
because a spread is really selling an option and buying an option. So you're in two trades at the same time that move together. So you still need to get out of both of those trades. And if there's no liquidity, like you're going to lose money in between the spread of these options, right? And if there's no
Yeah.
liquidity, and as you see, the lower the open interest, the higher the spread. So you could lose a lot of money getting out of this option because there's nobody there to trade with you.
Makes sense.
So that's one of my main determinants if I'm going to. So if I'm going to enter a spread, I do something like this. So bam, click that one. You see it's red because I'm selling it because I clicked
Mhm.
the bid. Then I hold down control on my keyboard and then buy the one that's two up. And the difference between those prices and this we're aftermarket is approximately 90 cents. That's the credit that I'm going to get, the premium I'm going to collect for every contract. Right? So if I did 10 of these, if I sold 10 of these, then essentially I would collect $900 in premium. And
Yeah.
then if that spread price goes up, I'm going to lose money. If it goes down, I'm going to make money.
I'm
Right?
with you.
So that's a spread. That is a bullish trade, but you're selling options, but time decay is on your side in that case. You make a little bit of money for every minute, every hour that passes by. On the other side, if I were to just buy, I would probably buy this one because there's more open interest, right? Here, there's no liquidity, so I wouldn't take it with the spread. I would just buy this one. But when I'm buying calls, I don't buy from this screen because I like to see what the chart is doing at the same time. So instead,
Hmm.
I will buy from the hourly screen usually or the daily screen. The price movement ranges look better on the hourly screen. That's why I like entering from here. And then I'll put the option up here and I'll trade active trader with the option so that I could really get like nitty gritty with the orders and figure out where they are on the chart. Where hey, the
Hmm.
current option price is at 370, but if I put it at 260, where is that where the stock price is going to be? And if I put it at $2, where is that on the stock Okay, it's a little bit below where I want it. Let me pull it up to 210, 250. That's right at the conservative zone where I want to enter, you know.
Yeah.
And then I'll preset my orders. I'll also preset my exit orders. When you're in a trade, you could put a sell order somewhere, right? So if this is 370 and I want to sell this option at 540, right? It won't let me because I'm not currently in a trade, right? But it'll set an order up there, right? So I don't even have to wait, or if it hits my target, I don't have to go and manually exit the trade. I could just set an order out there to exit the trade for me. And this is typically what I'll do, especially if I'm busy. And like, I'll just, hey, give me out a half of my position right here. And I'll set that order. And if it triggers, it triggers. And then I'll move my stop loss up after that. I'll move my alert up to break even.
Oh, they play with house money.
Yep. That's always the goal, is play with house money and try to get one of these winners that are over 100%, 200% that just keeps going until your expiration date. That is the goal, because that 100%, 200% winner is going to take care of the 3 to 4, 20, 25% losses you took.
Yes, sir. I agree 100.
Yep. Anything else specifically about execution? Because this is actually what I don't feel like on YouTube. No one teaches people how to execute the trade. They just go very broad. Buy a put, sell a spread. And they're like, no, but like, how do I do it?
Yeah, absolutely. I
Exactly.
agree.
What do I click? How do I enter that? What button do I press? What do I right click? Like, this is what I feel like I want to make this channel more about execution. So there's strategy. There are a million strategies out there that work. But like, how do you actually like put in an order for an option? How do you sell a spread? How do you buy a call? How do you buy a put? You know, how do you actually, what's on your screen when you're actually doing it? You know.
No, yeah, I agree.
Yeah.
This is way more
Yeah,
detailed
no.
than what most people will give you. Like you
Yeah.
said, it's very broad. You buy a call,
Yeah.
and they just show you how to enter the call, but not where to enter it.
Yeah. Yep. Anything else before we leave today?
Great
No,
game as
man, it
always.
was
Yeah.
very helpful. This is definitely one of the ones I'll be rewatching again. I try to rewatch them all
Yeah.
just to catch everything, but I'm gonna definitely make sure I rewatch this one.
Okay. For sure. Mokama Sunday service, making it rain without the
Without the
umbrellas.
umbrella.
8
Yes,
a.m.
sir.
every Sunday. Next Sunday, the live stream. This one, it was an hour and 30. They usually are only an hour, but we had a lot to talk about today. So, all right, fellas.
Appreciate you.
Till next time.
Appreciate you.
Yeah. Thank you.
Peace.
Peace.